Okay, so for chapter 12, we're going to go through the illustrative problem. I have taken the details in the illustrative problem and I have just entered it all in here so we can start using it. One other thing I did was I just added the total variable cost column. I did that by just taking the per unit cost and multiplying it by the number of units we expect to produce. Okay, so since we have all of that ready, let's get started on our homework. So, determine the amount of desired profit from production and sale of product M. Okay, so we've determined that our profit needs to be 10% of invested assets. Okay, so our rate of return that we're targeting is our assets multiplied by our 10% internal rate of return. Gives us 160,000. That is our target profit. Pretty simple. Okay, assuming that total cost concept is used, that's the important thing there. Determine the cost per unit, the markup percentage, and the selling price. Okay, so let's do cost per unit, markup, and selling price. Okay, so under the total cost method, the cost per unit is going to be our total costs right here for variable costs, total costs for fixed costs, divided by our number of units. Okay, so total cost is going to be our total costs, which will be our variable cost per unit multiplied by our units to get a total variable cost, and total fixed costs are given to us. Okay, our markup, we're trying to make a profit of 160,000. So our markup needs to be 160,000 divided by our total cost, and that will give us our markup. Okay, so we're going to take our 160,000. We're going to divide that by our total cost again. Okay, that gives us a markup of 5%. And so our selling price, so our markup, this is a percentage. So our actual markup in a dollar amount is going to be our current cost per unit using total cost multiplied by our markup percentage. So we need to add $2 to our cost, and that will be our selling price. So I'm just going to say add that. And there we go. We have our selling price. Okay, so 3, do the same thing with product costs. So let's try this again. Okay, so in the product cost concept, we need to use our total manufacturing costs or total costs related to the project. Okay, so our total costs in manufacturing are going to be direct materials, direct labor, factory overhead. Those are all related to the product. Selling and admin is not. We need to add our fixed costs that are related to the product as well. So that is our factory overhead. We are going to, once again, divide that by our total units that we're producing. Okay, so our cost per unit under the product concept is $30. And the markup here is a little bit more complicated because we need to include in the markup our selling and administrative costs. Okay, so overall, the idea is the same. We need to take our profit, but in this case, it's not just our profit, because we need to also include our selling and administrative costs. So we're going to add our variable selling and admin and our fixed selling and admin. And that gets us to our quote unquote markup. And then we need to divide that by our total manufacturing costs. Okay, so our total manufacturing costs, again, are going to be anything related to the product. So our variable manufacturing and our fixed manufacturing gives us a markup of 40%. So the markup of 40% itself is just our cost per unit times our markup percentage. So we need to mark this up by $12. I'm going to do that by just adding our original cost per unit. And there is our selling price. Okay, so if we use, now we're going to do the same thing, but we're going to use the variable cost concept. Okay, so this one should be a little bit easier because we've already done kind of a weird one here where we've had to add the selling and admin costs to the markup. But in this case, we're using variable cost. So we need to add a markup for our non-variable costs or our fixed costs. Okay, so this one's really simple. The cost per unit we already have over here. So we'll just say the cost per unit is the cost per unit. Okay, the markup, again, we need to add our target profit and we need to add our total fixed costs because we're using the variable costing method. Then we're going to divide by our total variable costs. Okay, gives us a markup up to 68%. So to figure out the markup in dollar terms, it's just going to be our cost per unit multiplied by our markup. So it's a $17 markup. And again, we're going to add that to our cost per unit, get $42. All right, the last part of this problem is kind of a big one. So I'm going to read the question first. Prepare a differential analysis report of the proposed sale to Wong. Okay, so assume for the current year the selling price is $42. 60,000 have been produced and sold. Indicates 15,000 units are expected to be sold. I received an offer from Wong for 40,000 units at $28 each. Okay, and I put that offer in my problem here. We'll market the units in Korea under its own brand name and no additional selling and admin expenses associated with the sale will be incurred. It's not expected to affect domestic sales and the additional units could be produced during the current year using existing capacity. Okay, so those last two sentences are really important. If this is going to affect domestic sales, then we need to look at this a bit differently. If we have to expand capacity, we would also need to look at this a bit differently. Okay, but because we don't need to do those, we can just assume that our fixed costs are going to be unchanged and that our current sales will be completely unchanged. So we can ignore those parts and just worry about what we're getting from Wong. Okay, so if we accept their offer, we're going to be selling them 4,000 units at $28 per unit. So if we accept, we'll make 112,000 in revenue, but we're a manufacturing company. We have some costs associated with that. So our variable costs associated with that are going to be $25, which we already have, multiplied. Oh, sorry, it's not going to be $25. Made a mistake there because the problem said we're not going to have to incur selling and administrative expenses. Okay, so our variable cost per unit for this is just our factory overhead. So we're going to take our product related costs multiplied by the number of units, and that gets us $80,000 in variable costs associated with those sales. And so our profit from agreeing to produce these for Wong is $32,000. So should we accept that offer? And the answer is yes, we should accept that offer. Now, something to be careful of, if we look at our total cost and get a total cost per unit, this probably doesn't pencil out. So if we take our total cost per unit, I'm just going to do this over here for a second. So our total costs are that. Oops, I guess I got to add all this up. Total costs are our variable costs there, our fixed costs there, our variable costs here, divided by our total units, which is going to be 80,000 for our regular business, 4,000 for our planned business here. Okay, so our total cost is $39 per unit, and we're only selling these at $28 per unit. Okay, so that's a common mistake that people think about there, but the reality is whether we accept this proposal or not, we're still going to have to pay this $1.2 million in costs. So although we don't cover our total cost with this, we cover our incremental variable cost with it. So now this $32,000 can go to support these costs, or it could be just extra. But one common pitfall is to look at total cost and look at the sales price. And in that case, we wouldn't want to manufacture this. But as I said, that's not the correct way to look at it. You want to only look at your variable costs. Okay, as always, if you have any questions, please feel free to reach out to me directly.